So we have the LCG logo and the risk warning on the screen. I hope everyone can see that all right. Seems like we're all okay technology-wise, according to my guys in the office. Getting a couple of confirmations from you chaps, so seems fine. We have had a couple of technology issues over the last couple of weeks, so it's a brand new computer, so I'm hoping it's all good. I'm hoping the audio is okay and there's no flickering on the screen, which we suffered a little bit from. So enough of all that. Yep, September 11th today. But in terms of what's on the agenda for markets this week, we've obviously just had our second massive hurricane gone through Florida, but obviously it's caused major damage in Florida. But from the perspective of markets, maybe if you're thinking about insurance company shares and things like that, it's not done as much damage as was previously expected, part of which is just because it was a category 4 in the end, not a category 5. You know, consideration perhaps when you're talking about currencies, maybe the broader stock market general direction. Does the Hurricane Irma kind of maybe delay the Fed raising rates a bit? Potentially. Yes, the market opinion in general that it doesn't take much to throw the Fed off. So maybe if growth is slightly slower as a result of kind of lesser consumption, etc., that's happening in Florida, you know, maybe that's boosted down the line when all the construction comes back. But for the time being, you know, maybe that dissuades the Fed from moving. On the flip side, inflation's probably been bumped up a little bit because we had that massive rise in gasoline prices. So yeah, you know, there are various economic impacts of the storm. Certainly, when you're working your way through the stock market, you think about, you know, some of the retailers may have lost business, but again, construction companies may be going to benefit. Insurance companies, you know, factoring in big losses, but as long as they don't have to go to the stock market and raise capital, actually that might be a bit of a relief to investors. Home here in the UK, we've got inflation unemployment stats. That's on Wednesday, I believe. But then following that, we've got the Bank of England meeting. As per usual, they're not expected to change interest rates, keep them at record lows of 0.25%. There is obviously a general kind of mood music in the market now that central banks are looking to raise rates, but they're just very scared to do so there. So that's why markets are skeptical. I'm certainly very skeptical. The question is for the Bank of England, do they react more to potentially slowing growth because of the higher inflation's eating into consumption now, or do they just focus purely on that higher inflation and get rates back to a more normal level and save any massive asset bubbles that, well, to be honest, have already happened, haven't they, in the stock market and the housing market, etc. It's more anecdotally than anything, but you know, you never know what affects the psychology of markets. It's the 10th anniversary of the Northern Rock bailout this week, so it's crazy that 10 years since then. In terms of the euro, we're obviously banging up against that 120 level. I mean, we're above it, but it's, you know, the 120 handle is the big one. And at the moment, the ECB are fairly obviously, not really being too subtle about it, jawboning the euro, trying to talk it down. We had Benoit Coeur, one of the ECB members, out today saying that the euro strength could lower the expected inflation. So if it's lowering the inflation in the eurozone, there's not such need to roll back the QE and start raising rates. And gold obviously had a huge week last week, but it came off the highs a bit towards the end. And now that these haven flows seem to be pausing, you know, maybe that's a reason for gold to pull back a bit from that 1350 that it hit last week. Big themes, all very much the same as per usual. Any questions on that? You know, certainly fire them through to me. Otherwise, I'm just going to get into the charts. Okay, so yep, starting off here with the with the euro chart. So we've got the 1850, which was the resistance, held at support, so did the 20 DMA. We had the ECB last week. This was ECB day, and then we came off a bit on Friday. We've kind of gone a little bit of nowhere since. But, you know, the reaction at the then the euro lower, but then it was, but then it wasn't, there wasn't really anything categorically dovish. They did, Mario Draghi was the first one to kind of start coming out and talking about the strength of the euro, or he referred to it as volatility in FX markets. It was pretty much code for, they're watching the euro to see if it infects inflation. Kur obviously came out explicitly today. So to my mind, it's still a pretty clear-cut bull trend. And we've had a pause at the previous high here, so some first signs that maybe the market's ready to roll over. I think the chances of a bigger pullback are increasing now, because you don't normally want to fight central banks, and they're talking down the euro, and we've hit that 120 level. So those two factors combined, I was saying very much the same thing last week, but after this ECB meeting, I'm having a bit more conviction about it. That said, to me, there isn't really any signal yet. You're being very, very hasty, a little bit early to the trade in my mind. If you're looking to sell the top of the euro now, I mean, if you use very wide stop losses, you're a longer-term player. Obviously, you've got your own strategy and how to implement it. I'm thinking about now is the time the market begins to roll over. But if you're looking for a more kind of precise trading entry, to me, there isn't. The signs aren't quite there yet. We're still in an uptrend, basically. How would we not be in an uptrend? Well, once the moving averages cross over, but obviously that's always a typically late signal. It's late, but you get rallies during that sell-off following the initial drop, where you can still participate in the trend. But I would say more specifically price action-wise, it's it's this low that I referenced before. It's basically the 19 level down to the 1850 is a kind of zone of support now. And so should the market drop through there, the next layer of support would be the 50 DMA, but it's not, that's not hard and fast. That would take us down then to this 1700 support, and then through there is when we're really starting to lose momentum. And it's not that you sell right at the 17 mark, but it's your sign that actually the market's not as bullish as it was, and then that's when you start looking for the sell opportunities. So again, getting a bit ahead of ourselves, but one market, if I quickly jump across to it, where we are seeing some euro strength, you could call it pound strength, euro weakness, but you could call it pound strength, is the euro sterling chart. Now here's more what I'm talking about, where the market pulled up, we had that bearish reversal signal. Now you do get a few of those along. You have one here, you have one here. It doesn't always result in the market selling off. Nonetheless, I did mention, I believe, at last week's webinar that we'd hit a massive long-term level. So if I pull out to the old weekly chart, it's pretty clear to see, isn't it? The 92.50. So big long-term resistance, a daily reversal pattern, followed through the next day, and ended up being a weekly, what would you call it, dark cloud cover, really. And it's been following through for the last couple of weeks, or last week, and looks like it is again today. So you had that, the follow through, found support, but we got some selling from the high. You could see that people were basically selling this 92, basically. We dropped through the support. We found a new support around the moving average. We pushed up to 92 again, still failed with another spike lower. Then we got the bearish engulfing candlestick, another couple of attempts at 92 with another bearish engulfing that took us below this support, and hence we're rolling over still. So probably at this point we're due a bit of a larger bounce for those who think that the bull trend is still intact and have been waiting for a bigger dip. You're getting into it now, but this is an example of the trend rolling over. So you obviously you can be very early, but you risk a scenario like these where actually the market hasn't fully topped yet. Once you get a bit of confirmation, some support being taken out, that's when you have a bit more confidence to sell into what could be a change in trend. Good chance of it, I think, given the long-term resistance, or what could just be a decent correction to sell into. Switching gears to sterling. So it was a great week last night in the last week in the pound. I don't always draw these trend lines, but in this instance, I had it drawn in just because I thought this was a significant kind of pivot level in around the 0.28, and I believe there was a fib there, which I've taken off the chart since. To be fair, it was through the 61.8. What if I? Yeah, so you get into the risk with Fibonacci's where you're just hunting for justifications for the trade. So we had pulled down through the 61.8 to be fair. It was basically that midpoint between the 61.8 and 76.4 is where the market eventually bottomed, which was basically a little false break of this low, which we did get a nice bullish engulfing candle from, and a kind of previous pivot area of, you know, this high over here, basically. If I draw that in, you can see that's basically kind of what that's what we're reacting to. And you can see bounce, bounce, drop through, bounce, you know, kind of bounce again, bounce again. So, you know, these levels are sticky over time. And again, you know, maybe that was a little early to buy just the bullish engulfing because the trend was still negative. But then we got the break of the resistance, got a pullback, a retest to the 61.8 as it happens, and then we've rallied up since, and we're pretty much up near the highs, and so we're going to probably start running into a bit of profit taking ahead of that 133. Does this trend higher in the pound continue? Well, you know, most of what I see on the chart suggests it does. That basically we're in a kind of steady basing pattern, having formed the lows down here. You know, we cracked the resistance there, we came back, tested a rising trend line. To me, we're making higher highs and higher lows. It's pretty much indicative of an uptrend. It's just a bit of a struggle, it's a bit of a grind because the sentiment is so negative on the pound. But at some point, you know, the mainstream viewpoint is going to kind of turn around to a bit more pound strength, and at that point, as you get that really solid midterm bit of the trend. So to my mind, it looks like we're going to break 133. There is resistance in this area, but we've already tested it once. So if we're coming up to it again, of course we can roll over. But to my mind, it looks like decent chance we break through 134, through 135, and then maybe we push hard from there. Quick look at dollar yen. There was a significant break last week, but we ended off the lows. It's not the most clear cut as you'd want it to be, because basically we cracked down through this strong resistance at 108.50, sort of 109, 108.50 support, but we closed off the lows. So to me, this still looks like a significant break. It's the lowest close for the week that we've had since the rally, so I think it does continue. You know, if again you look at all these inside bars, and then we closed at the downside. Yes, we finished off the lows. There's people buying dips. Maybe that's what's that, a 50% retracement? Maybe. I know that's the. Let's see, 61. So it's not even, you know, I think it's just a little fear factor. There's been a bit of dollar buying towards the end of the week. But to me, this looks like the dollar yen's rolling over a bit. The trend is not clear. You're basically buying the breakout into a new trend here, which may not materialize. But I don't think it's a bad move to look for signs of weakness into a retracement of this move. Just a sort of general by the by, it's not, you know, obviously it's all just rules of thumb and nothing always holds. But if you do have a breakout which finishes off the lows like this, what you tend to get is a higher retracement into the previous body of the candlestick. If you get a breakout where you basically, in this instance, say we finished right at the lows, there wouldn't be much of a retracement because people would be worried that the trend just carries on without them, and so they don't wait for as much of a move higher before the selling resumes. So by looking at the body, the wick of the candlestick, you can get a little sense as to people's desire and how desperate they are to continue the selling. With this weekly candlestick, I'd say people will probably be a bit more patient and you can wait for higher prices. Switching gears to equities. So you have had these same lines on this weekly chart for the FTSE for a while now. We've held the 72 300 mark. We're up to the kind of topper part of this range, which was our previous record high, on the 7450. So that's what we're aiming to crack at the moment. It's also the 20 DMA. So you know, a breakout above here, you know, probably corresponds quite well with a little breakout of any declining trend line that we have, and that could be a good sign that the market's about to continue. It's not really a clear cut for me at the moment. There's no obvious signs of a real bullish breakout. The only sign I'm getting for the FTSE to break out is actually just coming from other equities indices, namely the DAX. I'll jump straight to that. So I was a little bit early on a market snapshot video that I did. That was basically where we came off the moving average up here, and I think the timing of my video was this bullish engulfing. So they had a retracement into the bullish engulfing. The market did roll over, gave us another false breakdown here. So if you had just stopped beneath the lows, you probably would have been stopped out. But a big finish off the lows here. It was a false break. We didn't get a close below the support, and the market's been building up its momentum since. And then we broke out above these highs with that big bullish engulfing candlestick there. And as you can see, we finished very close to the high there, and there wasn't much retracement, and we basically continued on since. So we broke across the from the downtrending from the downtrend line, and now we've broken above the kind of pivot horizontal resistance. So a bit of a breakout materializing here. Why? Well, does it really matter? I mean, you can just see the trend is reversing, but if you're going to call it anything, you would say probably the euro looks like it's coming off a bit. The ECB, for what it's worth, maybe there's different interpretations currencies-wise, but as far as equities, it seems like they're not ending the QE program early. It may still be extended, so that supports risky assets. And it just looks like the German election is going according to plan. Looks like Angela Merkel's going to be a shoo-in. So maybe there was a bit of fear coming into the index, but we're 2 weeks away from the German election. Read our German election layout on the LCG.com if you wanted to get a quick overview of how it might. We've got a video there, of course, as well, just to see how it might affect markets. But you know, it's looking like it should be all right. So German stocks doing okay. Equally, this is a weekly chart here. So on a weekly chart, you can see the context of this August worries that weren't, basically, that, you know, we've had a very minimal pullback, but it looks like this rising trend line is pretty much held. A couple of attempt breaks lower of the trend line plus the moving average, and now we break into the top side above this 20-day moving average. So we're not into record highs yet. Maybe one thing to look out for tomorrow, and again, we've got a special report coming out, check your inbox, for the Apple results. Sorry, not results, but the new iPhone release. If that's well received, I mean, we've had a big leak, so people kind of know the information already. Quite a good chance, actually, Apple shares got bought on the rumors and sold on the facts. But if, you know, watch Apple shares. If the sentiment's all right, then that may help the Dow Jones move higher. And if this general kind of risk-on sentiment that we're seeing today continues, where maybe gold pulls back further, equities move higher, that could be the end of this little correction, which at the moment sort of looks a bit like a triangle. And I will just jump over to this gold chart. Now this is the long-term situation. You probably recognize this chart if you read it from our week ahead article. So you can see that 1370 is really the big one. To me, this all looks rather bullish. Now, obviously, at the moment, we're looking at maybe a little pullback in the flight to safety. not as much demand for havens, but I don't think that's the main catalyst here. The main catalyst is the dollar, and people just increasingly feeling that it's the other central banks that are probably going to start raising rates now, like the Bank of England, like the ECB, even if they drag their feet about it, and the Fed is probably going to be fairly slow about how quickly they raise rates. And the dollar appreciated massively in expectation that Fed was going to be much quicker than the other central banks. It's not been that much quicker. A lot of it's priced in, so the dollar looks like it's weakening, and that helps commodities. So, obviously, and depending on your political persuasion, you can factor in the bit of disappointment about what Donald Trump's doing as well. All that said, what I see here is a big move, a long-term move higher in gold. The pullback, no one was really sure whether 1,000 was going to be the bottom, but 1,050 pretty much did it. We had a big pull off the lows last year. We pulled back. We had another good start to this year, and now we're actually testing those peaks. So it looks to me like correction, break above some key resistance, pull back, higher low, and now we're attempting the second, if you like, higher high. And pretty much once we get, you can see the kind of peaks that have numbered around this 1370 mark. Once you get through there, you're kind of out of a base. And I think there's room for us to really push significantly higher. But let's not jump the gun, but just keep an eye on this 1370 level. And we'll just finish off with crude oil. Now, we did get a nice breakout through. If you follow me on Twitter, I pointed out this decent little break here, but this down sloping trend line, as you can see, proved to be a decent bit. Well, the trend line, but also just in confluence with this previous peak, both together were fairly formidable. Is just short of $55 as well. So if you call it the round number, the peak and the trend line together, it's tough to get through that kind of confluence of resistance. So if you're buying, it's a risky place to buy. If you're selling, well, the probabilities are on your favor when you have a line up, a confluence of different technical factors like that. And so we had a bearish engulfing candlestick in the end, and we're getting a bit of follow through today on the daily chart, that is. So watch this form of resistance, could just become support and trigger a rebound up through that trend line. But given that this is such a kind of choppy market in oil, I wouldn't be surprised to see that that support getting taken out. So I think that is about it. I didn't check the questions as I was going through. Let me have a quick look now. No, I think you've all been relatively quiet on this one, but I do appreciate your attendance. Thank you very much. Good luck with trading this week. Jasper signing out.